Good. I'm pleased to present and moderate, as we said, the Earthstone Energy this morning. I've known the team for quite some time, and I believe they're definitely one of the best operators in the business, as you can see by what they've been able to do with their track record. I currently have a buy rate on the stock, $7 price target, so I think there's tremendous upside. Today with me is President and CEO Robert Anderson. Robert's been with Earthstone and the predecessor companies for, to me, what feels like going on about 30, 40 years or so, as he was recently handed the keys by Frank. So I think Frank's now, who's chairman, has got a lot of confidence in Robert and the team. With Robert today, Mark Lumpkin, CFO, and VP of Finance, Scott Thurlander. With that, let me turn it over to Robert and Mark for some comments. And then I've actually gotten, looks like a lot of emails that have already come in, some questions. Robert, when you're done, or Mark, why don't you kick it back to me and I'll hit some questions.
Hey, thanks, Neil. Thanks to Intercom for setting this up. I know we're in unique times, and so far so good with meetings yesterday, and hopefully this fireside chat, and encourage all the questions you guys might have out there who are listening or watching. Earthstone is a unique story. We are a micro to small cap company, but we are set up with a platform that is very healthy, and the ability to grow in this environment is something we are fortunate to have. We've got a great balance sheet, low leverage, no obligations. We'll be free cash flow positive and paying down debt the rest of the year. And with this platform, we intend to be a consolidator in this environment. Unfortunately, there is a lot of distress, and I'm sure we'll talk about it as we go through the next few minutes, but we look forward as a company long past the survival stage. The first 2 quarters were kind of rough, but we don't even think about survival. We think about opportunity and opportunistically growing in this environment. So Neil, I look forward to the conversation over the next few minutes.
Good. I've got a lot of questions. Maybe right before we dive into sort of ops and financial details for you and Mark, maybe just a little macro. I think it's always interesting to hear your perspective. Obviously, there's a lot of chatter out there about potential political changes, not only with Biden wins, but just again, if across the board, Democrat controlled. And, the question would be, do you or Mark, when you think about this, strategize with Frank and the team, do you think there could be material changes? Again, where you are, I don't know if I see as many, I don't want to answer, but again, I'm just kind of curious how you all think about it. I mean, look, this could be something as soon as January if we have a new sort of political in office, and just wonder what your thoughts are on that.
Yeah, it's something we've started to talk about a little bit. We can't control it. We can vote, but we can't control the outcome. So we're going to be responding to that. I think from an Earthstone standpoint, where we're exposed, you might say, is just from a tax standpoint. I truly believe, given the fact we have no federal acreage, we're not, in New Mexico or other Western states, or we're not offshore, that won't impact us. And I also believe that the states are going to try and maintain, and will likely be successful in maintaining regulatory control. We're doing all the right things from an environmental standpoint. We limit as much as we can flaring, so from that standpoint, I feel really good about how our team operates. And I just, again, think the biggest risk is from a tax standpoint.
Yeah, agree. Okay. And then let's move to strategy wise. A lot of chatter, a lot of sort of investor comments are always about balancing production growth and free cash flow, what I call sort of free cash flow / shareholder return. We've talked, some bigger companies talked about variable dividends. Others have said, no, it's still about production growth in the business. Robert, as I mentioned, the prepared or early comments, you guys have been around a long time. I'm just wondering, how as a company you think about that?
The investor appetite is definitely changing, which means companies have to adapt with that. We, like I said, will be free cash flow, obviously, the rest of this year, paying down debt. There is a combination that we think in the small cap world makes sense of a reasonable amount of leverage, which is low, 1.5 times, and a reasonable amount of growth within free cash flow. positive. So if you can live within a cash flow world and stay reasonably levered and have growth, that's the best of all worlds. And we as a company are set up to do that. We can have a one rig program beginning next year, and we will be free cash flow positive depending on the level of non-operated activity. But on the operated activity to run one rig, we'll end up being free cash flow positive next year under a reasonable price tag. If oil goes below 40, all bets are off, and we're sitting here going, okay, where's the next dollar we're going to spend? But I think for small cap companies, and for the way we look at the world, is we're going to try and maintain a fair amount of free cash flow on top of a one rig program.
So tying into that, I'm wondering, you've got, I think, in Upton County area, about 11 ducks and you're currently in, I guess, right now, really not in your 2020 budget. And I think, currently, I know you're not running a rig. So kind of given those two scenarios, how do you all think about, as you just said, when you think about commodity prices and other factors, what would sort of motivate you to resume completion and pick up a rig? I guess that's my first question when you think about all that.
Yeah, from the completion side, it's a little bit easier. Point forward economics, assuming the drilling capital is sunk and you just look at point forward economics, we would have good economics on those wells into the $30 WTI pricing. But we have no obligation to produce those barrels today. I mean, it's all HBP lands. We do have a partner in 5 of those wells. And so in combination with our partner and ourselves and our board, we think about our overall growth. We can spend $30 million to complete those wells, and we can do it end of this year, early next year, and we'll keep production flat or relatively flat next year as well. So this year we've got a guidance number out there of 13 to 14,000 BOE a day. Spending that $30 million next year, we keep on the low end of that range perhaps, but production relatively flat for 2021, and deliver a whole lot of free cash flow, only spending $30 million. That's a pretty luxurious spot to be sitting in at the moment. And it gives us a lot of flexibility. When you think about a drilling program, we're planning for a drilling program next year, maybe not to start the beginning of the year, but after the first of the year, we'd probably want to get a rig back working. But a couple things have to be in place. One is we're not going to start and stop. It just is very difficult on an efficiency basis, and we have no obligations to go drill wells to where we need to pick up a rig, drill 3 wells, and then let the rig go. So we're looking at, if we can get oil trending in the right direction, north of $45, we have good economics to continue drilling our development plans in Upton County and in Midland County, where we have acreage. And those economics are still really good at a $50 price tag. So that's what we're looking for kind of 2021 activity-wise based on commodity prices.
Okay, and looking at kind of, as you were just talking about, maybe looking at some of these ops issues, I'm just wondering in I guess either Reagan or, kind of your areas that are more active or will be more active and have been more active. Could you talk about sort of formations that, are in play when you think on the development side or the exploration side? I mean, right now, when you think about it, and I guess 2 questions there, Robert. One, if you go and tackle it next year and you become more active, would it be just more developmental? And if so, what kind of zones would you target? And number 2, if you look more exploration and upside, what other potential zones are there?
So in a good question about, do we focus on just purely development and make sure we're drilling the highest rate of return projects, or do we kind of set ourselves up for the future a little bit as well? And we'll let the other folks around us set ourselves up for the future. We're not going to take too much, we'll call it exploration risk. Luckily, in most of these areas, folks have done enough testing of other zones. We know what works in the near term and what can be put on the shelf for a better price environment. So let's boil this down. In Upton County, the benches we have are 3 solid benches in the Wolfcamp, A, B upper, B lower, and around our what we call Ratliff-Benedum area in eastern Upton County, we've had an operator drill a couple of C wells that look very good, and we've drilled one C well also. And this is not your Reagan County C. This is a little bit enhanced C wells from the average you might see in Reagan County. So good results in the C from an offset operator, and we'll have that well completed sometime next year. When you move over to Midland County, in the block of acreage we have there, not only do we have the Wolfcamp, but we also have Sprayberry rights, and we've seen good results in our lower Sprayberry drilling. But folks around us have drilled Joe Mill with some pretty terrific results. So all of those are, built into our program over time. And then we'll continue to look at upside. The Wolfcamp D in Reagan County looks very good in a few wells, and some middle Sprayberry benches up in Midland County look good in a few wells. And so we just need to see some more performance and some more development.
And maybe to tie onto that, could you talk about it, especially in the developmental areas, but even maybe the others? Could you speak these days about how dense, you think it is kind of adequate in that area? We actually just ran a study, and you all don't seem to run quite as dense as, what I've noticed some other bigger guys are, especially running quite dense in, kind of the more central northern Midland areas. But I'm just wondering, what do you feel comfortable with? And I guess, do you have an estimate yet on that on the exploration side?
Yeah, sure. It all boils down to what price deck you want to believe in or you have in front of you, right? If oil's $100, our density probably can go up. It's just a matter of economics. But in this environment and the way we're planning, a $50 world, we're looking at spacing around 1,000 feet between wells in the same bench in Reagan and Upton County. As you move into Midland County, you have a little bit more pressure, you're a little bit deeper, and generally speaking, you can have a little bit higher density, maybe by one more well per mile wide. Instead of 5, you can go to 6. But we also worry about the adjacent benches. So if you're looking at a Wolfcamp A and a B upper and B lower development, you have to pay attention to what that interwell spacing is between the offset benches to make sure you're not communicating there. So when we drilled our 3 wells in southeast Reagan County, the WTG block, we did some pressure testing on those wells as we had shut those wells in during the month of May, and gathered some really interesting data that suggested the spacing down there was about appropriate. We didn't see too much interference and maybe just about the right amount. Again, as prices improve, we may change that, but I think going forward, our plan is somewhere around 1,000-foot spacing between wells in the same bench.
And part of that same vein, I know in the past you've kind of, as you said, you bring a rig, you're not going to take it and let it go, et cetera. From fracs, though, you kind of group them. Could you talk a little bit about, especially for a company your size, the benefits and kind of, will that still be the plan for going into next year?
Sure. There's a lot of factors that go into that. There's operations, there's logistics, there's the physical fracking of it, and then there's the parent-child or co-development, things like that impact timing of completions, things like that. So the way we look at it is you go drill an area, a sliver from top to bottom of what you want to complete, the Wolfcamp A down to the Wolfcamp C, for instance, in Upton County. And we've drilled 6 well pad there. And as we get 6 or 10 wells in an area, then we'll bring in a frac crew and do that. Running a 1-rig program, we don't have the ability to keep a frac crew running full time. So that's how we gain the efficiency. There is a little bit of lag, and therefore our production becomes a little bit lumpy in terms of bringing wells on, but we maximize the team's efficiency and lower the cost that way. And we found that worked really well last year as we brought on 10 or 12 wells towards the end of the year, all being fracked back to back across various areas of Reagan and Midland counties.
So I noticed, Robert, in your slides, most recent ones that Mark's got out, I've noticed that the frac costs per stage have continued to come down nicely. Is that because of that? Is it more service costs have come down? Is it a combination of all these things that cause, on the fracs per stage to come down like it has?
Yeah, it's definitely a combination. We see this as a team effort. We need the service companies out there making enough to keep their equipment running, the most efficient it can. And we've got to give them enough leeway in terms of timing or other logistics or other services showing up on location. So it's a very coordinated effort on both sides. And if we're not making money, that means the service company's not making money. So we feel like if we can make a buck, then they're going to make a buck as well. And it's both efficiency and cost. We started out 2019 around 6 to 8 stages per day. And we ended 2019 and the wells we completed in early 2020 at 12 or 13, and some days we got 14 stages a day. That efficiency gain, less days on location, less cost of that spread out there benefits everybody.
And these days, what is it? I guess just on simple terms, spud to rig release. What kind of times do you think are manageable when you bring a rig back now in the middle of the basin where you're at, or especially for an operator like yourselves?
Yeah, I mean, that varies by area in the basin even. Howard County, which we're not an operator up there, may be one thing. In Midland County, it's a little deeper. In Reagan County, it's shallower. And it also is impacted by lateral length. So you're drilling short laterals. You still got the same vertical section you got to drill through, but a 4,000 or 5,000 foot lateral section, it is really easy when you're drilling 10,000 foot laterals because that last 5,000 feet go very quickly. Generally speaking, I'd say 15 days spud to rig release. There's companies out there who can do it in 10 or 12, depending on where you're at and what kind of drilling issues you may or may not run into. So we kind of plan around 15 days or so, and our goal is to beat that. And we've had some success in Reagan County where we've run rotary steerables on really long wells and had really good days, and therefore been able to achieve that and lower.
Robert, my question, and maybe I'll cue and Mark a little bit too, as far as would LOE, you've got slides that show how that LOE is really continue to knock down almost quarter after quarter. And I'm like, kind of thinking, is it more challenging when you slow down like this? I guess just if you could just kind of give us, an aspect of it. And then my second part of that question for Mark is, when he's doing some of his planning on this, is he planning for LOE to sort of continue? I mean, again, it's been pretty fantastic to watch what you all have been able to do, more than a lot of my other companies that we cover. And I'm just wondering, if you think you'll be able to do that. And again, question for Mark is how, when he's forecasting, what he's thinking on that going forward.
Yeah, from an operational standpoint, we definitely focus on costs in the field, and our guys are incentivized by not only keeping wells producing as many days out of the month as possible, but trying to find ways to lower the cost. And there's no mandate from us to say, hey, you have to do this way. It's you guys come up with the best way to reduce costs and find a way to do it. And we've continued through the life cycle of wells, gone from compression, gas lift to plunger lift or rod pump. That does reduce the cost by itself, right? I mean, we're getting rid of a compressor that's $3,500 a month or something like that on an individual well basis. That sure helps our costs. And as wells get lower, the production gets reduced, we don't have as much saltwater disposal. We've got some good saltwater disposal contracts in place. We've paid a higher fee up front to get that capital cost paid out to go to third-party water disposal. And then we've hit payout, and now that cost reverts to a much lower number in some cases. We've gotten rid of generators in areas where the utility company was slow to get meters set, and that's really helped. And we've been able and fortunate to use relationships to get in the front of the line. So some of these things we did during the first and second quarter are sustainable. Some of the things that, as prices increase, I would expect chemical costs to come back up a little bit. But the vendors are working with us, just like the service companies. When we go to frac wells, they're working with us to lower costs because, there's somebody else out there. There's a competitive market out there we could go to, but we tend to work hand in hand with our vendors on all these operational things. Mark?
So Mark, how do you think about forecasting that based on what Robert was saying?
Sure. Yeah, we'll say, just echoing Robert's comments, one silver lining of the circumstances of the past 4 or 5 months with us laying the rig down and finishing up completions and setting down the frac spread is our operations team has had an opportunity to go do deep dives. That's been positive, and we've seen some fantastic results. And really, I mean, our operations team, we would stack up head to head, not just with people our size companies, but companies of any size in any basin, and feel confident in how they would shake things out. Um, Now, I'll say as you look forward, we're never going to put a permanent forecast on the trough prices, whether that's on LOE or DNC costs. Right now you could probably go drill and complete a well pretty darn cheap. As we're thinking about 2021 and what's it take to resume completions or pick up a rig, we're not using these trough prices. That's the same on LOE too. And to Robert's point, if we wake up tomorrow and oil's $60, there's going to be some upward pressure on the LOE costs, from chemicals to vendors to whatever. You'll see, we hit 453 a barrel of LOE in the second quarter. What we've sort of got implied is a bit higher than that for the rest of the year. Are we still trying to hit 450? Absolutely. And we're pushing that, but we're also realistic that we've got some declining volumes as we're not bringing on new wells. And frankly, some of the things we did in the second quarter were fantastic. We think a lot of that is repeatable, but the way we plan, there's a little bit of conservatism in our view, and we're careful not to get ahead of our skis in terms of, promising delivering, making sure we can deliver what we promise.
And for Robert, Mark, what do you think? Mark, you brought this up just on a per total cost per DNC. A lot of guys are out there. First it was, "Hey, I can't believe we can get it under 1,000." Then it was under 900. What on a per foot, Robert? What can I push you to plug into my numbers by next year?
Yeah, we did 750 in the first quarter on those 3 wells in Southeast Reagan County. I know that our guys can beat that number going forward. Obviously, current rig prices are lower than what they were in January through March. Frac spreads are a little cheaper now. So I believe today that, if we were out there drilling, we'd be in the $650 per foot range. But I think in a more normalized $50 price environment, we're going to be back in the, $700 for us is going to be our target. And we're going to be able to beat that, hopefully, most of the time. A lot of factors go into that. You're drilling a 1 well pad, it's going to be a little more expensive. You're drilling short laterals, a little more expensive. But 10,000 footers or 8,000 footers, and you got 5 wells per pad, the efficiency gain there is tremendous.
And Mark, Roberts brought up kind of that $50 mark several times. What can you talk a little on hedging? Obviously, hedging were fantastic for you early this year, part of last year. And I'm just wondering, again, as you sort of sit today, and especially into 21, what maybe just remind us of the hedging strategy for the company?
Sure. For this year, we're close to 90% hedged for the balance of the year on the oil side, and a little less on the gas side. Next year, just where I've seen consensus, I think we're probably about 50% of our oil hedge relative to consensus, which sort of assumes we complete the DUCs, but no incremental adds from new rig activity. A couple things I think that we think about. One, first of all, hedging is a discipline. It is not a call on commodities. It is done consistently with discipline, with the intention of mitigating risk. It's been very effective the last year. Certainly, there's been some times where some of our hedges didn't look as good, and this is why we hedge for in this case, a triple black swan event. We're going to continue doing that. We've got a pretty good deleveraging profile as we're paying down debt at a nice clip this year, and really next year, presuming just the 30 million to complete the DUCs. The more levered you are, the more you should be hedging. The more debt we pay down, we feel a little less of a need to hedge further out, but we like to be a pretty decent chunk of PDP hedged out 18 to 24 months or longer. We've started to look a little bit at 2021, and it's pretty close to 45. We could do that, and with our hedge book for 2021, a bit over 55, do some kind of blended average and still have an over $50 hedge book. And we likely will layer some on closer to the end of the year. but it is, looking at sort of time and leverage profile and, what prices look like as well.
And does your hedging factor into, I know fall redetermination, again, you all seem to be sitting better than a lot of others, but it sounds like more of it's a system, I guess my question, you kind of answered it before, Mark, it sounds more systematic. That doesn't impact, hey, we've got a fall redetermination, you just had your prior redetermination, things like that. It's, maybe talk about that redetermination and
Sure.
maybe hedges around that.
Sure. So on the margin, as it relates to doing the borrow-based redetermination, I mean, the hedging, it's helpful, and it particularly if there's a decent bit of room between what the bank price deck is and the strip, it adds value, and they like that downside protection. I mean, there's been times in the past where we were kind of going back and forth on, hey, maybe the number's X and maybe it's X minus 5%. And well, if we do some extra hedges, we'll be at X instead of X minus 5%. That's a reasonable and constructive dialogue. In general, we think we're going to get some of the benefit of the LOE improvements we've had in really the past 4 months. That will offset some of the natural downward pressure on the borrowing base. And we'll start that process, in full here in the next few weeks, and are probably a little ahead of schedule than where we typically would be. From that standpoint, if you're just looking across the sector, hedges are rolling off, PDPs rolling off. Maybe price decks improve a little bit versus what the bank's worst price deck was in the spring, but they're also not going to get aggressive on price deck. So, like, generally speaking, we're very confident that ours will be very manageable, and we're optimistic about that. And really, even on our worst case scenarios, we're in totally fine shape in terms of liquidity to resume our CapEx program. Broadly speaking, we think there's going to be quite a bit of pressure on E&P companies, as there's, in a lot of cases, an inability to pay down as fast as the liquidity is decreasing with the borrowing base decreases.
Got it. And hey, Mark, if I'd ask you and Robert the same question as far as where you'd ideally like leverage, would I get the same answer these days?
Pretty close.
Yeah, we're both the one-time guys or less. Outside of an acquisition that is highly cash flow driven.
I sat on the RBL side for a good chunk of my career and did some workout. Robert has had Frank for 20 years, scaring it into him, and I've seen it firsthand. And no, I want to avoid being anybody's workout group.
Got it. Well, and Rob, what you said leads me into: are you all continuously, of course, be remiss, we didn't touch on a bit on M&A, and just, are you looking for maybe two, separately? One, just maybe talk about bolt-ons around where you are. Is there any opportunities like that? I've seen you pick up little pieces, not as much recently. Maybe just talk bolt-on opportunities first.
Yeah, there are still some bolt-on opportunities, and we were actually working on one early in the year, but there was quite a bit of bid-ask spread. We could see that the strip was coming down, and the seller or potential trade partner seller was still viewing things in a much loftier oil price strip, and it didn't make sense for us. We didn't need to do anything. It just makes our economics a little better and our operations a little better if we can drill 10,000 footers. But at the end of the day, we got what we got, and we got pretty decent economics. We don't need to do anything, and so why pay a price that you're just totally uncomfortable with, first of all. And so there'll be continuous opportunities to bolt on, and some of them are a little bigger than just a piece of acreage. They may have some production and maybe 4,000 or 5,000 acres and a little bit of production, or 1,000 barrels a day. Those opportunities are going to continue. There's a number of private equity sponsored companies in the Midland Basin that at some point, they need to do something with their asset. It will be divested at some point or rolled into something. So we stay front and center with most folks out there in the basin.
Let me come back to M&A side. Somebody had hit a question. I want to make sure I want to make sure we don't run on time or anything. Somebody had just asked, and it's something I probably should have hit earlier. They just said, hey, on a gross well basis, 35% of your wells are in the Eagle Ford. What's the plan for that play going forward?
Yeah, that's a good point. The Eagle Ford's a great play. It's about 15% of our production. Maybe it's, about 15% of our revenues. It's more oil weighted than our Midland Basin assets. It's 85% plus oil. We get good pricing, but we have drilled all of our inventory that works under a $50 price tag. Everything else we need a higher price tag. And so it's an asset that will continue to contribute cash flow and borrowing capacity, but at the right time, it could be a divestiture candidate as well. And, at that time, as soon as we can find something in the Midland Basin or other assets in the Eagle Ford, which we're looking at, maybe then it becomes a sale candidate.
That leads me back to the M&A, looking at accretive deals. Now you kind of teed that up. Would if you saw the right deal that you all, through, Mark runs the numbers, you run the numbers, you believe to be accretive, would you, obviously, ideally, I'd say, you stay where you are specifically the Midland Basin, but that put words in your mouth. Beyond just that, would you look, I guess, two questions here. One, would you look beyond just the Midland Basin? And two, you said this with bolt-ons, are bid-ask spreads still just too darn wide that there's not a ton out there? Or, why haven't we seen, many deals out there?
There's a lot of questions in there to unpack. Let's start with the last one. The lack of a capital market, debt or equity, and the lack of a robust RBL market make the acquisition market very difficult for smaller companies. Bigger companies can access the public markets very easily, and we've seen a lot of that. We've seen a couple deals over the last month or so. And last week, the Swin Montage deal, is a good example of ultimately what needs to happen in this industry. There's just too much overhead, too much cost leaking out of the system, and the investors aren't happy about that. And one way to fix that or control that is more consolidation. There still is a bid-ask spread, although we've seen lately that perhaps some of the private equity guys are willing to have conversations because the volatility that we saw early in the year, March and April, is subsided some. And now it's a matter of what do you think that strip price is going to be, for the near term. We are definitely looking at a lot of different opportunities. Some of them are driven by bankruptcy or restructuring. And some of them are just driven by it's time for private equity or larger companies to sell pieces of their asset and, core up or focus or maybe de-lever a little bit. We have spent time in the Eagle Ford and the Midland Basin and the Delaware in terms of looking at opportunities. And, we're late to the Delaware party, you might say. We never were in a lease position out there, but we're getting smarter technically on it. We really like some of the results in the Delaware Basin, and we'll continue to monitor situations out there.
Robert, is it just, why have we seen on the Delaware, a lot of people that have both, specifically sort of central southern Delaware, that they've really come back and focused more on the Midland? Is it just, again, I don't want you to speak out of school, but again, I know you know both pretty well. We've definitely seen a notable amount coming back to the Midland versus focusing on their Delaware right now. Or just purely economics are still better in the Midland, do you believe?
Yeah, I think there are some great well results in the Delaware Basin, no doubt about it. In cases it's a little deeper, higher pressure, better results. But in some cases it's a little gassier. The Midland has no lack of infrastructure, and it has less subsurface risk than parts of the Delaware Basin. So, I think operators find that the cycle times, the repeatability, and the economics are, just a little better in the Midland Basin. And so they're willing to spend more of their capital dollars there than in the Delaware.
So if I could ask, it's like we're coming up in 25 after it's a couple minutes. Robert, based on what you said, again, it still seems like through my conversations, there's a lot of privates that again, I think their PE sponsors are getting a little impatient out there on just them. They were used to sort of the buy and flip method, making a bunch of money in a short amount of time. Some are not even running a rig now. Some are doing pretty minimal sort of cash flow. So two questions here. One, do you think because of that, sort of maybe PEs, do you think the private market, I don't want to say it, have you seen it open up at all yet in the last couple months? And then number two, the question I always get, just either in the private or overall public market, about just consolidation. We obviously probably should hit that before we let go. That consolidation question always comes out. So really just private and consolidation before we wrap up. What are your thoughts on both?
Yeah, the consolidation, I think, continues. I just don't think the pace of it is as fast as anybody wants, whether it's an investor or a particular buyer, consolidator. Just there's a lot of factors that go into that. You have personalities and boards and lack of capital availability, like I said earlier. All those factors go into the consolidation game as well as the private game. And I think the private model is changing and being adjusted. And on the fly, these PE shops are making the appropriate adjustments within their portfolios to be able to survive longer without a active divestiture market or an A&D market. So they've got to find a way to rebrand their portfolios. And one way to do that is consolidate amongst themselves or within a portfolio and cut costs and learn to live and survive longer in this kind of lower price environment where there isn't an active acquisition market.
Got it. Looks like we're coming up about 25 after. We cut it now, or what? Do we have time for one more? Anybody out there?
I'm here. Go ahead and ask one more.
Okay. Well, just Robert, on that last one, consolidation. Again, just in industry wide, I'm really curious to know. Again, you've been through a lot of cycles. This one seemed to be, as you said much earlier, a little unique on what investors are looking for. More based on two things: what investors are looking for, and number two, just what's available out there. I'd say more so in the public market. Small combining with small, larger ones, rolling in some others. Just your thoughts broadly on consolidation.
Yeah, I think it has to happen again because there's too much cost in the system, and we need to take that out so the investors come back into this business, right, and invest in us. It would be easier if oil was $60 or $70. We're not going to control that. So we as an industry will control what we can control. The number of smaller companies, and it's kind of grown over the years because of capital markets and IPOs or reverse mergers. And we've been a beneficiary of using the reverse merger method a number of times, has done well for us. But since 2014, when we saw this kind of world war erupt on prices in the United States, and we've gone from $100 to where we, down to negative and where we are today, it's been a rough ride for everybody. And consolidation, I think, is slow when a lot of restructuring needs to happen. But there's no driver for that outside of perhaps a forced court process. So I believe that it's going to happen. It's going to be slower than we need. It's going to be driven by some forced restructurings, and it'll bring opportunities to us and others. And sooner or later, we'll have fewer companies. We'll have stronger companies who can survive the volatility that we're probably going to see for the rest of our careers.
Great point. Robert, Mark, obviously enjoyed the time. Always love chatting with you all and look forward to catching up. Guess we'll let those guys sign off for us.
Thanks, Neil, and thanks to Intercom. And we appreciate everybody's attendance and interest in Earthstone.